Hello, everyone. Today on the Final Bar, very excited to chat with Jeff Hirsch, editor of the Stock Traders Almanac. We'll hear some of what the Almanac is telling us and what his analysis is telling us about what to expect. Overall, pretty decent day with the S&P getting closer and closer to 4,000. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the best practices of technical analysis. I was taught that technical analysis is valuable because it helps you get inside the head of all the other investors, helps you measure investor psychology, not just think about investor psychology, not just try to understand it, but really quantify what investors are thinking, what they're feeling, and how the emotions are driving their buy and sell decisions. Arguably, all of that is reflected in price, as our chief technical analyst, John Murphy, wrote many, many moons ago. So overall, what are the conditions as we look at them today? Overall, it's hard to look at a day like today and a day like yesterday and not see that as fairly constructive. You're seeing additional demand as prices go higher. You're seeing stocks like Amazon, some of those mega cap names leading the way. Anytime when you have an Amazon in the top 10 list, how bad can the markets be at that moment? Probably not too bad. However, plenty of headwinds probably still out there. We'll try to pick through some of those while we can. Great schedule here coming up. As I mentioned, we have Jeff Hirsch of the Stock Traders Almanac and Hirsch Holdings joining us here in a few moments. Tomorrow, on Thursday the 12th, we have Tony Dwyer, the Chief Strategist at Canaccord Genuity. Next week, two really good guests, Bob Lang and Dana Lyons will be joining us both on the show. Charting Forward, which is our 2023 Market Outlook Special, will be airing this Friday, 10:30 a.m. Eastern. Charting Forward is a really cool event, the first of many roundtable discussions we're planning to have through the course of 2023 and beyond. I'll be joined by Greg Schnell, Tom Bowley, and Mish Schneider. Have a great discussion about what we're seeing, what we're thinking, and what levels and what indicators and what tools should be most of interest to you. You can find more info at stockcharts.com/charting-forward. Let us continue on our show today with our market recap. As I mentioned, decent day for stocks with the S&P closing right around 3970. Nice move higher after closing yesterday around 3920. We're getting closer to a number 4 at the beginning of the level of the S&P, which could be a significant level to breach. Let's look at the S&P up 1.25%. The NASDAQ composite leading the way higher, 1.8%, we'll call it. Mid caps and small caps both up as well. And volatility increasing. So again, I'm often, I have people caught in the trap of saying the S&P and the VIX are just inverse to one another. So why look at the VIX? Because it's just the S&P upside down. Not the case. There tends to be that inverse relationship, but you will find not always the case, right? And there have been plenty of days here recently where you see stocks and volatility both up, stocks and volatility both down. Today's one of those days where you have the S&P going higher, the VIX going higher. And I would argue the fact that volatility remains, I guess, elevated is the adjective I would use to describe above 20. We're still sort of in that higher volatility environment that was really part of the story, I think, in 2022. We rally further and the VIX goes below 20. I think that could be a really positive, constructive development, but we'll see. The good news is, as one of my mentors, Charlie Kirkpatrick, used to say, volatility does not equal risk. Volatility equals opportunity. Looking at the interest rate markets and bond markets, interest rates all down today for the most part. So you have the 10-year yield down around 3.55, long bond yields below 3.7%. So you're seeing rates come down. And what that usually means, if you know your equity relationships to the yield curve, lower rates tends to be better for growth stocks. Higher rates tends to be better for value stocks, just kind of generalizing about that relationship. So lower rates really giving an opportunity for things like technology, consumer discretionary, maybe communication services to emerging in a position of strength. And two of those three at the top of the leaderboard today. Commodities overall, for the most part, positive, although gold and silver actually flat to down today. So gold, which had been one of the real success stories in the fourth quarter, starting to stabilize a little bit, starting to stall out just a touch. Still seeing plenty of strength in the gold names. When I was scanning for stocks making new swing highs today, Agnico and Kinross and a bunch of those were sort of on the new swing highs list. But for what it's worth, gold price is stalling out a bit. The rest of the commodity space doing just fine, and energy related commodities pretty good. Overall, Bitcoin, Ethereum, the cryptocurrencies still trying to recover those previous levels. As we mentioned, Bitcoin 18K is sort of a general line in the sand I've been paying attention to. Not quite there yet. And the reason why I focus on a big level like that is Bitcoin tends to be pretty noisy along with the rest of cryptocurrencies. Identify a level. What I like to do is identify a level, put a price alert, and just let the system tell me when that level is breached. Until then, don't worry too much about sort of nitpicking on the little short-term trends. When Bitcoin gets above 18,000, you'll probably hear my tone of describing the chart a little more constructive, because that shows that we're actually following through to the upside. Let's look at a chart of the S&P 500 here to continue on our market recap. Again, I put this big green line. I feel like the more we test it, the thicker I make the line. I have a couple more thickness levels left before I break stock charts by trying to make it a too big of a line. But overall, it just becomes more and more important, right? And the reason why trend lines like this are so meaningful, in my opinion, is because the more you test a line like this, I would argue, the more it sort of represents, or more it is validated as a representation of the trend, right? This trend line connecting the 2022 highs lined up so beautifully with the August peak, so beautifully with the November and December peaks of last year, and it lines up with the peaks earlier in the year. And it's not like there aren't a lot of movements below that trend line and plenty of things to pay attention to. But my question is, until we're able to break that trend, how good are things really getting? Because as long as we remain below that trend, whatever rallies we get, it's not enough to change the character of the chart and really starting to push things through to the upside. Having said that, we are a rounding error away from the 200-day moving average, which is just above current levels, currently around 39.87. One big update tomorrow clears the 200-day, which we've not really been able to do since the first quarter. We attempted it there in November, December, but stalled out very, very quickly. A trend line is just above there, around 40.30. And then we have 4,100, which is the swing high in November and December. I would argue the bull case for stocks, before we get to S&P 5,000, we have to get above S&P 4,100. So looking at this sort of confluence of resistance and seeing if we have enough in the tank to push us higher than that, I think, is a really important open question. Also, look at the momentum, right? The RSI is so far just below 60. That's where we topped out here in November. That's where you often top out in a bear market phase. Do we have enough positive momentum to push above that level? Now, having said that, there are plenty of stocks that actually look pretty constructive, and I'll highlight some of those, right? There are charts that have been working, right? Things like energy stocks, like Schlumberger, SLB comes to mind, pulled back recently, but overall the trend has been very, very positive. A chart like Etsy was actually kind of a broken chart for the first half of 2022. So if you look at the left, sort of the middle of the chart here, the stock topped out in November and was in a pretty good downtrend until May, June of 2022. You can see how the stock was underperforming the S&P, which in itself was in a downtrend. So not only were you in a downtrend, but you were underperforming the benchmark. Look at how that changed. Starting in June, that's been the low point for Etsy. From there, we have a bit of a rotation higher. We have sort of this resistance range around 120. We finally break above that. We pull back to the 50-day moving average, now resolving to the upside. The relative strength trend is pretty strong. So the fact that charts like this are out there reminds me that regardless of what you think about the overall market environment, there are charts that are kind of working. There are also charts that concern me a little bit. And I will tell you, a chart of like First Solar comes to mind. Really strong chart and a really constructed pattern. We've highlighted this one, so don't assume that I'm not saying it's been a really fantastic chart, which it has. But I have to highlight the shooting star candle. If you know your candle patterns, when we open, we trade higher and close back toward the lows. That might indicate upside exhaustion. I'll be watching this through the course of this week to see if we get that downside follow through, which often follows that shooting star pattern. Let's take a quick break. We'll be back with today's guest, Jeff Hirsch. We'll see you in a minute. Hey, everyone. Welcome back to The Final Bar. This is Dave Keller here at StockCharts.com. Thank you so much for joining us every weekday after the close as we try to make sense of these markets together using the power of technical analysis, one of the best ways to really try to quantify what is happening around us as investors. We're going to bring on today's guest, Jeff Hirsch, of the Stock Traders Almanac here in a moment. Do want to make a couple quick announcements before we do so. First off, we welcome your questions. We had a great mailbag segment on yesterday's show. We're going to do it again on the end of the week on Friday's show. We love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv, and we're on YouTube. Put a comment below the video you're watching on our YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. That is our repository online for all things stock charts, all market analysis, all of these great guest conversations and special events like the pitch, our market outlook special coming out on Friday. All are there for free at StockChartsTV.com or on your mobile device. Just search for Stock Charts TV on demand. I am super excited to welcome on today's guest, Jeff Hirsch. Jeff is the CEO of Hirsch Holdings, is the editor of Stock Traders Almanac, technical analysis royalty, I would say. Your father, Gail Hirsch, was foundational, really popularized a lot of the things that many of us take for granted when we're understanding the equity markets over time. Jeff, great to see you and welcome to the show.
Good to see you, Dave. Am I going to see you in person again soon?
We'll see, right? So it's awesome to have you on. I know you just published at the end of last year, the latest edition of the Stock Traders Almanac. I get one every year. I have it here on my desk with me to follow things and what the calendar is telling us. We're here in January, which a lot of people sort of think of, set the stage for the year. What are you seeing this January and what should we be looking for here?
Well, I mean, what you want to see if you're a bull is January to be up. This is the January barometer that my father invented in 1973. There's a picture out there on the internet of the 73 Almanac with also the Santa Claus rally that he invented, created, discovered, whatever you want to call it, that has been misunderstood, and it gets misunderstood every year, and I have to explain it every year. So what we want to see in January, and then there's also this first 5 days indicator, which I'll tell you about in a second, but January, used to be a much stronger month. It's really been a month of profit taking and concern, and like the last 20 years or so, it's really had a number of losses, some severe damage. 08, 09, those periods, and other years. So what we're seeing here, you're looking at this chart of the 21-year performance of the five main indices we track in the Almanac. And we look at 21 years as the recent history. It's a number that you'll see throughout the Almanac because it's long enough to give you a decent, statistically significant amount of instances, short enough that it's recent, but also an odd number because we don't end up with any 50% days, some half being up, half being down. So that's why it's 21 and not 20. But you've seen some weakness at the end of the month. If we see strength and a full strong month, as Yale said years ago, as the January goes, so goes the year. So here we are. It's about the seventh trading day today, I think. So, that little peak there, you might want to just concern yourself. That we've come a ways. We're waiting to see if January comes in positive, and if it can buck this recent trend, I think that's even more bullish for 23.
Yeah, it's really interesting. It lines up pretty well with our earnings season, right? Sort of getting started at the end of this week too. That could be an interesting could be an interesting impact to January.
That's probably what drives it a bit too. That regular behaviors of human beings that do the same thing every year. That's what sort of makes these patterns happen.
Now, we were talking before we went live about what you call the January indicator trifecta. Can you just talk us through this table and what it tells us to expect here?
Well, I mentioned before the January barometer and the Santa Claus rally. Santa Claus rally, which I'll just define it for you. It's not any rally from October through January. It is the last 5 trading days of the year and the first 2 of the new year. It is not a big trading strategy. Everyone wants to say, "Oh, we're going to trade the Santa Claus rally this year." It's an indicator. And my father was a songwriter. You don't know, he passed away at 98, late 21. He came up with that phrase that everyone uses out there. If Santa Claus should fail to call, bears may come to Broad and Wall. You don't know, New York Stock Exchange is at the intersection of Broad and Wall Street in Manhattan. So basically what you have is a period of time where a lot of people take time off, myself included, and you got the pros picking up bargain stocks, stuff that were sold for tax loss selling purposes. And that's why you get that rally. And it's also, okay, the new year's coming. Are we feeling good? Is our analysis, are our technicals looking good? Are the fundamentals looking good? So that's the Santa Claus rally. Then you have a very old indicator called the first 5 days. We call it early warning system in the Almanac. It's on page 16. Santa Claus rally is page 118 if you're following along at home. First 5 days is an old indicator. It's been around probably since the 40s, which we've been covering the Almanac in all 56 years. And then the January barometer, the full month, all based on the S&P 500, by the way. Full month, as January goes, so goes the year. As we were saying before, January's kind of taken it on the chin a bit over the last couple of decades. Standing on Yale's shoulder about 10 years ago in 2013, we combined all three of these to be our January indicator trifecta. And what you're seeing here in this table is when all three are up. We've had the first two up, Santa Claus rally, eked out a gain. Average is about 1.3% for Santa Claus rally. But these are all kind of binary. It's either up or down. I mean, it's not magnitude oriented. First 5 days were up. We had some nice action there in the market, some pretty solid up days. And then if we get the third leg of the trifecta, the January barometer up, you have full year gains, 28 of the 31 years here since 1950, where all three were up, 90% accuracy ratio, up 17.5% on average. The last 11 months, so if you're not including with the gains in January, up about 83, 84%, 27 of 31 up, 12.3% average gain. Pretty solid.
Very interesting. So I love that. So the first two, we've had the check in the bullish column. If we get a positive January, all of a sudden it lines up with some of these previous observations and some pretty encouraging statistics for what the rest of the year could hold. Now, your next slide is basically assuming, let's say we don't get an up January, then what would that potentially mean for us?
Well, unlike last year where we had a positive Santa Claus rally and a negative first 5 days and a negative January barometer, which had us be even more bearish or even more cautious than we started out the year, being a midterm election year. Get into that in a second. But when you have January down of the 12 instances, when you have up Santa Claus, up first 5, takes a little bit of air out of the market's gains, but still pretty solid. Last 11 months, up 10 of the 12, average gain about 10%. Full year gains a little bit lower because of the weakness in January included there. But again, 2 out of 3 ain't bad, as the song or saying goes. And what remains to be seen. We have to see how the month ends. If we can get some additional data points with CPI continuing to mitigate, inflation continue to come down, some sign that the Fed's kind of where it needs to be. We think they're going to pause, in Q1, not cut, not pivot, but just, it does take some time for things to come through. So January trifecta, no matter how you slice it, it's looking positive already with 2 out of 3 positive.
Now, your last chart, Jeff, is getting to the presidential cycle. We actually had a panel on StockCharts TV, but it might have been a couple of years ago now that I think about it. But I remember you were on there. We were talking about some of the presidential themes. The midterm year, obviously a challenging year for stocks. 2022 was a tough one. Tell us about the period we're in now, and what does the presidential cycle tell us about 2023?
Well, first of all, the presidential cycle is very important in the stock market. Each year, it's kind of a 4-year cycle for the book. It's the midterm election year edition. This year is the pre-election year edition. So midterm election years, as my father said years ago, are bottom picker's paradise. We had a textbook, prototypical midterm year bear market with an October low for the Dow and the S&P, Russell 2000 June low, NASDAQ a little lower in December on a closing basis, but not intraday. So you have most of the markets, recessions, bear markets, wars happen in the first 2 years of the presidential cycle. Second 2 years are better. The third year has really been the standout. Most of the markets, best gains are there. 16.2% on average versus sub 8% on the other 3 years. And what we see here is this sweet spot of the 4-year cycle. So granted, you see 21, 22 laid out in a black line. The green line is all the years since 49. And that sweet spot, the 3-quarter combo from midterm Q4 to pre-election year Q2, averages about 20% on average, Dow and S&P. 29.3% NASDAQ. And you see it kind of flatten out there in the worst 6 months, at the just after the green bar there. And then at the end of the year, you see pre-election year, the actual high almost comes in the last trading day of the year. So if we didn't have a bear market in midterm year and we didn't have that typical October bottom, I wouldn't be as constructive, to use the word you used and that I like to use also. I could say bullish as well. The word bull is in my headline for the forecast we put out. We think it's going to be a little choppy here in Q1. We think the Fed's going to pause in Q1, and that it's typical pre-election year action. Pre-election years after midterm bear markets are even stronger, up about 20%. There's a chart on the page 11 of the Almanac that you have there that shows that.
I actually was looking at that earlier this week. I feel like I mentioned it on the show, Jeff, and I love that talking about after a bearish, midterm election year, what tends to happen afterwards. So, with that as the backdrop, when you're looking at the markets now, you mentioned a lot of uncertainty, which is true. Right? We have a big question mark around the Fed. We have earnings season starting here in the next week, which certainly could provide a catalyst. Is this an environment, given the presidential cycle projected strength? Is this a time where you add risk? Is this a time where you approach things more cautiously? How do you approach this sort of period as an investor?
We've already been adding risk. We're pretty much long. We were getting out of things all throughout 22. We had heightened volatility, bear market stuff. We were in cash by the time we got our MACD seasonal best 6 months sell signal April. We got a buy signal in October. We're adding risk right now. It's almost getting back to buy the dip if you're not in already. I mean, I'm long a bunch of things personally. You said energy before. I have some smaller energy stocks that I own and the XLE. So I think that's a good place. FCG, the natural gas, is on our newsletter recommended list. I didn't grab that one myself. I missed our buy limit. But I think you're adding risk. I think you're being patient. I think you're using technicals like we do. And we use 5 disciplines. We use fundamentals, technicals, seasonals, monetary policy, and sentiment. So stick to your techniques, your methods, use your technicals, overlay with fundamentals and seasonals, and look for stocks that, of good values and sort of under Wall Street's radar and sectors that are going to benefit from, China reopening and some things like that. So, you got to do the homework and read the Almanac.
There's some great broad themes, certainly macro themes to think about, Jeff. We only have about a minute and a half left, but I love to just think, as you mentioned, you think the Fed may potentially pause, maybe, which has been obviously one of the big headwinds for risk assets in 2022. As we're navigating sort of what this looks like to come out of this Fed tightening cycle, I guess the way I would ask it is, what would tell you that conditions are not improving in a way that you're sort of looking at? Is there a specific level on the S&P, or is there a signal that would tell you, okay, this is not as positive as we imagine? Or is it breakdowns in some of the individual names? Plenty of individual stocks are having some pretty good runs so far. What do you look for that tells you, downside risk is more significant?
I think there's a couple things. I think your trend line is spot on. The 200-day. I think we got to clear the December highs there, and then the August highs. So technically, we got to make some more advances on the downtrend. And then there's the economic numbers. If inflation, CPI doesn't continue to trickle down, GDP is still looking good. We look at the Atlanta Fed GDP now forecast or estimate, which is better than any of the consensus estimates out there. And, if we start seeing a lot of stops get hit in our stocks and whatever ones you're trading, it's a combination of those things. It's not binary. It's not one indicator. But, we got the tailwind of the midterm bear and the pre-election year with us. The Fed's looking like it's getting tired of beating up the market, and inflation's, at least headline, and those numbers are starting to come back a little bit. So if that doesn't happen, we'll be more cautious. But right now, we're cautiously bullish.
Jeff, you managed to turn my bearish question into a bullish answer. Well done. But thanks. I think that's really, really valid. Listen, it is awesome to have you on the show. Thanks for taking a little extra time with us and sharing some of the charts from the Almanac. I'm not kidding. I have the Almanac in my bag. I just grabbed it out. I look at it every day. So thank you for editing it and keeping it going every year, following on your father's work, which was exceptional. And stay safe, be well. We'll talk to you again soon. All right.
Appreciate you guys. Thank you.
That's Jeff Hirsch. Jeff is the CEO of Hirsch Holdings and the editor of the Stock Traders Almanac. A lot of those things like, things on seasonality, the Santa Claus rally. Santa Claus should fail to call. Bears may come to Broad and Wall. I remember living in New York, going down to Wall Street, having that quote in my head as I'm doing it. So pretty cool to talk with Jeff, who's just kept some fantastic work going with the Stock Traders Almanac. As a reminder, we actually have the Stock Traders Almanac for sale at the StockCharts store. On the StockCharts website, go to the store, 30% off right now if you buy the 2023 Almanac. So certainly check it out. Other thing I would mention, again, I think Jeff's take was just fantastic. And I love thinking about the seasonality, that strength from sort of the fourth quarter of the midterm election year through potential strength in the middle of the pre-election year was really, really interesting. I hadn't thought of it that way. And it really lines up with the October low, which is what's so powerful and so interesting. So great take there from Jeff Hirsch and some really interesting charts to help us think. We need to wrap the show. 30 minutes goes by so quickly when we have some good content. Fascinating markets and a good guest, but we have to go to the 3 and 3, 3 charts in 3 minutes that tell the story of this market environment. Chart number one, a shout out to my friend Jordan Ewell, who's at Stonecastle Investment Management, north of the border in Kelowna, British Columbia. I was chatting with him earlier this week. He's a fellow CMT. We were talking about a number of things market related. He showed a chart talking about equal weight stocks versus cap weighted stocks. So RSP versus SPY. And we talked a little bit about that. This used to be one of my favorite risk on versus risk off measures, meaning when this ratio was going up, it usually meant risk on because people were going more toward kind of the more speculative mid-cap part of the S&P as opposed to the mega-cap, traditionally more defensive part of the S&P. The ratio has not played out that way. It's been raging higher in 2022 after going lower in 2021. So I have learned that this ratio tells me personally a lot less about risk on and risk off and more about leadership. When this line is going up, it means the mega-cap names are underperforming. It means probably those sectors like tech and consumer and communications names are struggling relative to the other things, the cyclicals and other value-oriented sectors. That is where the pattern is. It's making a new 52-week high in the last week yet again, which tells me it's still the smaller parts of the S&P that are working. Chart number two, 10-year Treasury yield, $TNX. I couldn't help but notice I often talk about rates go higher, value tends to outperform. Rates go lower, value tends to underperform. That has worked really well until the last couple months when value continues to outperform whether rates are going up or rates are going down. This is a really important line to watch, this ratio, looking at value versus growth, still favoring value. So if you're really bulled up on stocks, doesn't necessarily mean you need to buy growth. There are plenty of opportunities in value-oriented parts of the market for sure. Finally, we'll finish the show on a high note. I was writing a note to my premium members of Market Misbehavior earlier today. One of the stocks we highlighted was Charles River Laboratories, CRL. This is a biotechnology name. If you look, sort of setting up a classic bottoming pattern, what we'd call an inverted head and shoulders. If you're not familiar with that, it's basically you have a low surrounded by two higher lows. Here you have a couple different things, but kind of the low here, you have a higher low in June, a higher low in December. The neckline is connecting the interim highs between those lows. It's right at 250, which is essentially today's high. So a close through 250, if we get above that level, that would complete that bottoming pattern. That would be a Dow theory uptrend. That would be a really encouraging development in an area of the market, biotechs, which could have upside potential as long as they're able to follow through above resistance. Folks, it is such a pleasure to put this show on for you. Thanks so much for joining us every weekday after the close. Special thanks to Jeff Hirsch of the Stock Traders Almanac sharing some thoughts and charts with us today. All of our previous interviews are at StockChartsTV.com. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be safe, be well. We'll see you tomorrow.
Hey, Grayson Rose here with Stock Charts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.